Welcome to Vskills YouTube channel. In this video, you will learn about the top interview questions for credit risk. So, let's get started. Question number 1. What do you mean by credit risk? The answer is, credit risk is the possibility for a loss to occur due to the failure of a borrower to meet its contractual obligation to repay a debt. For example, a homeowner may stop making mortgage payments. This is also called default risk or counterparty risk, and pertinent credit events may include bankruptcy, failure to pay, loan restructuring, loan moratorium, or accelerated loan payments. Question number 2. What is a credit default swap? The answer is, a credit default swap is one of the most used methods of mitigating risk in fixed income, debt security instruments like bonds, and is considered as the most common financial derivative. Credit default swap is essentially a type of investment insurance that allows the buyer to mitigate his investment risk by shifting risk to the seller of a CDS in exchange for a fee, and the seller of the CDS stands in the position of guaranteeing the debt security in which the buyer has invested. Question number 3. What is the reason for high-profiting sales to mitigate credit risk? The answer is, it is observed that high-profit sales reduce credit risk by providing a greater profit incentive in case the borrower is unable to pay the debt. Credit risk is concerned with the likelihood that the borrower is not financially able to pay the debt. The less likely the debt may be paid, the higher the credit risk. This is related to the risk-return trade-off. Question number 4. What does a Z-score refers to? The answer is, Z-score refers to a predictive coefficient of corporate failure developed by Edward Altman. Question number 5. Which financial statement shows source and application of funds? The answer is, cash flow shows the source and application of funds. Question number 6. What are the types of credit facilities available for an organization? The answer is, there are two types of credit facilities available in an organization. Short-term loans. They are primarily for working capital needs. For example, overdraft, letter of credit, factoring, export credit and more. Long-term loans. They are required for capital expenditure or acquisition. For example, bank loans, notes, mezzanine loans, securitization and bridge loans. Question number 7. What is operational risk? The answer is, operational risk is the loss that occurred due to a business operations that is a process, human resources, systems, external events. It also comes about through external events such as political, legal, and fraud risks. Question number 8. Define market risk? The answer is, market risk is the risk caused by unexpected changes in market factors such as interest rates, stock prices, commodity prices, and foreign exchange rates. Question number 9. How is credit risk measured and on what does it depend upon? The answer is, credit risk exposure is measured by the current mark-to-market value. The magnitude of credit risk depends on the likelihood of default by the counterparty. The potential value of outstanding contracts. The extent to which legally enforceable netting arrangements allow the value of offsetting contracts. The value of the collateral held against the contracts. Question number 10. What is collateral? The answer is, collateral represents a repayment source in the worst-case scenario. Most banks require that the loan be 100% collateralized. This means that the business has to have enough collateral to cover 100% of the loan amount. For example, if a loan for 50 rupees lakhs is needed, then a car, equipment, building, and inventory must possess that add up to 50 rupees lakhs. Question number 11. What is the most common risk metric in loans? The answer is, the most common risk metric is the adequacy of loan loss provisions and the size of the loan loss reserve about the total exposures of the bank. Allowance for loan losses creates a cushion of credit losses in the bank's credit portfolio. Primarily it is intended to absorb the bank's expected loan losses. Historically, credit decisions were made on a case-by-case basis. Question number 12. What is a credit default swap? The answer is, a credit default swap is a frequently used method of mitigating risk in fixed income, debt security instruments such as bonds, and it is one of the most common financial derivatives. It is essentially a type of investment insurance that allows the buyer to mitigate his investment risk by shifting risk to the seller of a CDS in exchange for a fee. The seller of the CDS stands in the position of guaranteeing the debt security in which the buyer has invested. Question number 13. What are the different categories of risks? The answer is, typically banks distinguish the following risk categories: credit risk, Market risk, operational risk. There are further types of risks, such as strategic risks, or reputational risks, which cannot usually be included in risk measurement for lack of consistent methods of quantification. Question number 14. How are expected losses derived? The answer is: unexpected losses are derived from the borrower's expected probability of default and the predicted exposure at default less the recovery rate, that is all expected cash flows, especially from the realization of collateral. The expected losses should be accounted for in income planning and included as standard risk costs in the credit conditions. Question number 15. What tools are used to manage risk? The answer is: tools that are used to manage risk. Root cause analysis, SWOT analysis, risk assessment template for IT, risk register, probability and impact matrix, risk data quality assessment, brainstorming. Question number 16. What is a good debt-to-equity ratio? The answer is: the debt-to-equity ratio is a key, if not the primary, financial ratio considered in evaluating a company's ability to handle its debt financing obligations. The debt-to-equity ratio indicates a company's total debt about its total equity, and it reveals what percentage of a company's financing is being provided by debt and what percentage by equity. Question number 17. How are lending limits set? The answer is: a system of credit limits restricts losses to a level that does not compromise a company's solvency. Lending limits have to be set taking into account capital and resources. Any limit on credit has to be accompanied by a general limit on all risk assets. This would enable the business to hold a minimum proportion of assets such as cash and government securities whose risk of default is zero. Question number 18. What do you mean by diversification? The answer is: diversification involves the spread of lending over different types of borrowers, different economic sectors and different geographical regions. To a certain extent, credit limits which help avoid concentration of lending ensures minimum diversification. The spread of lending is likely to reduce serious credit problems. Size, however, confers an advantage in diversification because large businesses can diversify by the industry as well as the region. Question number 19. How can companies reduce credit risk? The answer is: companies can reduce credit risk by raising credit standards to reject risky loans, obtain collateral and guarantees, ensure compliance with the loan agreement, transfer credit risk by selling standardized loans. Question number 20. What are solicited ratings? The answer is: solicited ratings are ratings that are initiated and paid for by the issuer. Occasionally, issuers may not opt to be rated as they rarely raise debt or equity in international financial markets. Another reason is if the issuer is apprehensive about getting a negative rating that may limit his or her future access to funds. Question number 21. What does rating outlook indicate? The answer is: rating outlook indicates the medium-term potential evolution of the rating in the future. A favorable or unfavorable outlook means that the rating may be increased or decreased. A rating with a stable outlook will most likely not be changed. A developing rating outlook indicates that the rating may be lowered or raised. Credit watch lists are used to determine shorter-term changes. This means that the rating is put on the watch list when an event deviates from the expected trend and there is a good probability of a change in the rating. Question number 22. What do you mean by exposure at default, EAD? The answer is: the exposure at default pertains to the amount owed to the business. Therefore, apart from the type of claim, the amount of the claim is also a significant variable in the credit approval process. Question number 23. What is loss given default, LGD? The answer is: the LGD is the ratio of the loss on an exposure caused by the default of the counterparty to the amount outstanding at default. This ratio is calculated by businesses following the Internal Ratings-Based Approach, IRBA, for their retail portfolios. The estimated LGDs are necessary for the capital requirement of the institute because of incurred credit risk. The pricing process of credits is also highly affected by the accurate estimation of possible losses. Question number 24. What is the interest coverage ratio? The answer is: this is commonly calculated as EBIT divided by interest expense. It is also referred to as the times interest earned ratio. The interest coverage ratio indicates how easily a company can cover its interest expense with operating earnings before interest and taxes are subtracted. Question number 25. What are the limitations of value at risk? The answer is: the value at risk analysis has limited descriptive ability. Even though it showcases the figure of losses within the confidence level chosen, It does not indicate any prediction about the probability distribution of losses beyond that confidence level. Going further, the value at risk misses taking into account any extreme events in an economic crisis with extremely high default rates. The value at risk relies on certain assumptions and estimates which can lead to misinterpretations of the risk. There are constraints to the comparability and aggregation of different types of risks caused by the different distribution of the risk types. Question number 26. What are the two types of assessments? The answer is: the two types of assessments are qualitative assessments and quantitative assessments. These are then often used together to produce an accurate credit assessment, where the two are usually carried out in parallel. Insights obtained from one aspect of the investigation leads to investigation in the other. While the various approaches are used to assess credit quality, they are often used as a combination in the decision-making process. Question number 27. What does modern finance theory imply? The answer is: modern finance theory implies that declining credit may not necessarily be the proper response to low credit quality. The view of modern theory about risk postulate is that the necessary return should be adjusted for the risk taken. If the risk has been correctly calculated, then losses will be compensated by gains elsewhere. Question number 28. What does return on equity indicate? The answer is: return on equity indicates the rate of return on equity capital and is particularly on equity capital significant in the context of the objective of maximization of share value. Equity is the sum of share capital, preferred shares, paid in surplus, retained earnings and reserves for future contingencies. Question number 29. What are securities? The answer is: securities help to defend an entity from possible credit loss situations. There are several tools or securities that an individual or firm can use to best guard themselves in uncertain times. These may be in the form of stocks, property, gold, etc. A security assures the lender that the borrower has a stake, equity, or risk capital to fall back on in the event of a default. Question number 30. Why do businesses need working capital? The answer is: all business needs working capital to an adequate supply of raw materials for processing, cash to pay for wages, power and other costs, creating a stock of finished goods to feed the market demand regularly, and the ability to grant credit to its customers. For more such videos, subscribe to our channel.